Good evening to all the participants today. Good evening to you all. We are back again with our regular video lectures on financial management. Yes, good evening to you all. So in our last session, we started with chapter called Dividend Decision, correct? We will continue with that chapter today as well. But before we start with today's session, let's briefly recap or quickly recap what we have done in the last lecture. So in our last lecture of dividend decision, we first under the objective of the chapter was to decide whether the company should pay dividend or not, and yes, should optimum dividend payout ratio. Correct? This is what we have learned. Then, apart from this, we also learned some theories given by finance scholars. Just to quickly recap, we learned Walter's theory of optimum dividend model. Then we also learned Gordon's theory, Gordon's dividend approach. Then we learned dividend model given by Graham and Dodd. And apart from these three theories, we also learned some theoretical part of this chapter, like different forms of dividend. What do you mean by stock split? What do you mean by stock repurchase, etc., etc. So these were the topics that were covered in our last session of dividend decision. Now, friends, tell me the formula of market price given by Walter. It was something like this: D plus E minus D multiply by ROI divided by KE, the whole upon KE. Can you see my screen now? Yes. Can you see it now? So basically, in our previous class, we learned dividend models given by Walter, given by Gordon, and given by Graham and Dodd. As per Walter, the formula to calculate market price of share today, which is denoted by P0, was nothing but D plus E minus D multiplied by ROI divided by KE, the whole divided by KE. Correct? Then we also understood about the assumptions given by the Walter. I briefly explained you the derivation of this formula as well. So this was Walter's model. But the core content of Walter's model was, if ROI is greater than KE, it means company has more earning capacity or more efficiency to multiply the revenue than the investor has. So optimum dividend payout ratio was 0% in this case. Correct? Hope you are able to recollect. Then when ROI is less than KE, it means company has less earning capacity or less efficiency to multiply the retained earnings than the equity investors. So in that case, it is better to pay off 100% dividend and let investor earn or multiply their returns more. Okay? So Walter's model was all or no approach. Correct? This was the case. Then Gordon's formula. Second, we learned Gordon's formula. See, this chapter is all about remembering the formulas. If you are through with the formulas, then dividend chapter is very simple. Okay? So you need to remember the formulas. Gordon gave the formula. Formula of Gordon was D1 upon P0 plus G. Sorry, not P0. This was KE ka formula. Formula of Gordon was D1 by KE minus G. Okay? This was the formula. And again, the derivation of this formula we have learned in our previous session. Then Graham and Dodd. As per Graham and Dodd, price of the share today, or the intrinsic value of the share today, is nothing but D plus E by 3 multiply by the multiplier. Formula was something like this. And again, we derived the formula of gram and dot as well. We have understood the entire derivation as well. Yes, Aisha, correct. Understood. So these were the topics that we have covered in a very detailed mode in our previous session. Now, today we would be learning model given by MM. We would be learning MM approach of dividend. We would be learning Lintner's model of dividend. We would be learning residual approach of dividend. These are the learning objectives. And if time permits, we will also briefly discuss the concept of valuation of stock or shares. Okay? These are the learning outcomes of today's session. We would be learning MM approach of dividend. We would be learning Lintner's model of dividend, residual approach of dividend, and if time permits, we will, in short, quickly understand how valuation of shares work. Okay? So any doubts, any questions still here? Yes, Manvi, that is correct. Your formula is correct. Any queries? I have just briefly or quickly revised the previous session and just gave you the brief insights of what we would be learning in today's class. Okay. So now let's start with MM approach. See, before we start with MM approach, Lintner's model and residual approach. Lintner's model and residual approach are more of a practical approaches of dividend. They have not analyzed whether dividend decision will affect market price or not. They have not analyzed that part. According to this model, they are simply like, what should be the current year's dividend practically. This is how they have framed that model. However, MM approach, Gordon approach, Walter's model analyzed that does dividend decision affect my market price or not. This was the revolving factor of their entire theory. Does dividend decision or optimum payout ratio or dividend payout ratio of the company affect market price of the share or not? So Gordon and Walter said that yes, it definitely affects. Any changes in dividend decision or changes in dividend payout ratio will definitely affect or will definitely change the market price. But there was one man who said that irrespective of company's dividend decision, market price of the share will not change. Neither the wealth of the shareholder will change, neither the value of the company will change. Are you understanding? MM says that dividend decision does not have any effect on the wealth of the shareholder. So this is the core content, the core revolving factor of MM approach. Following? So what is the crux of MM theory of dividend decision? That irrespective of company's dividend decision, meaning that irrespective of company's dividend payout ratio, wealth of the shareholder will not change. Wealth of the shareholder will not change. It will remain same. It will remain same. And not just the wealth of shareholder. MM went one step ahead. He said that value of the firm will also remain same. There will not be any effect or there will not be any changes in the value of the firm. This is the core content of MM approach, core or the conclusion of MM theory of dividend. Now let's see what was his logic. His logic was very simple. His logic was very simple. See, this is the balance sheet of the company. Okay, this is the balance sheet of the company, and in the balance sheet on current asset side, can I say there would be some cash and bank balance with the company? Let's say it is 1 lakh. And can I say the owners of the company, the ultimate owners of the company are different equity shareholders? Yes or no? Would be different equity shareholders. Correct? They are the ultimate owners of the company, means they hold the ultimate ownership of all the assets and liabilities. Bolo, any query still here? Any query still here? So can I say the bank balance of 1 lakh is owned by the shareholders? They are the ultimate owners up to the proportion of their shareholding, but they are the owners of this bank account. Correct? So they have the right on this bank account up to the proportion of their shareholders. Now, if the company pays dividend to the shareholders, can I say the company would be paying from this bank balance only? And it will go to the bank account of these individual shareholders? Yes or no? So can I say in other words, dividend is just transfer of funds from one pocket to another, from one bank account to another bank account. Transfer of funds from company's bank account to individual bank account. Are you getting this? So in this case, is the wealth of the shareholder changing? It is just a mere transfer of bank account or bank balance or funds from company's bank account to individual bank account. जैसे let's say I have two bank accounts, one in Kotak Bank and one in Axis Bank. If I transfer some funds from Kotak to Axis, will my wealth increase or will my wealth decrease? Just by mere transferring of funds from one account to another, will the wealth increase or decrease? It will remain same, obviously. So this is the logic of MM. He backed his theory, he backed his conclusion that dividend is just a mere transfer of funds from company's bank account to individual bank account. Company's bank account was also owned by those individuals only up to their shareholding percentage. Are you getting this? So this is the core logic of or the crux of MM theory. So just like all the authors gave their formula, MM felt little inferior there, that everyone is giving their formula of market price. I should not be left behind. Even I should give my own formula. So as per MM, he gave formula of market price today. The formula is P0 is equal to D1 plus P1 upon 1 plus KE. What is P0? It is market price today. Market price of share today means at 0 point. P1 is nothing but price at the end of year 1. Expected market price at the end of year 1. D1 is nothing but expected dividend at the end of current year. At the end of year 1. KE is the rate of return of investor. Rate of return of investor. Whatever they expect is return to them and cost to the company. So expected rate of return. Expect of investor. So basically, MM said that price, the share price of today is dependent primarily on two factors. The expected dividend in the coming year and the expected price of the share in the coming year. You just discount these two factors. See, 1 plus KE is nothing but 1 plus KE raised to 1. Can I say this is nothing but discounting of future cash flows? Future cash flows in the form of expected dividend in year one and in the form of expected price in year one. I hope under investment decision, we have briefly discussed how to discount the cash flows. In that case, the present value of cash flows was nothing but cash flows in year one, and we used to discount it with the discounting rate. Yes or no? This is how we used to discount the cash flows. So here also we are discounting the cash flows, but here the cash flows are in the form of expected dividend and expected price. And said that the price of share today is just dependent on the dividend and price of the coming year, next year. Don't think much about the future. Don't think much about the future. He said, आने वाले एक साल में क्या होने वाला है? बस. Future is very uncertain, and whenever there is uncertainty, risk is involved. So don't think much about future. What is your expectation in the coming year? You discount that. That is your value today. This is what simply said. What is your expected cash flow in the coming year? You just simply discount that. That is the value of share today. Understood, friends? Any queries? Any questions? Did you understand the logic why said that wealth of the shareholders will remain same? So it is just, he said that it is just a mere transfer of funds from one bank account to another. D1, sometimes it will be directly given. They would use some wordings or phrases like the expected dividend in the coming year is so and so. And if not directly given, then you have to add growth to it. KE is the expected rate of return of investor. See KE, how to calculate KE? We have learned that in cost of capital chapter. KE is cost to equity of the company, correct? So whatever investor expects from the company is income to them, but cost to the company, obviously. Whatever investor or whatever shareholders, whatever equity shareholders expects from the company is income or return to them individually, but cost to the company. How the value of the firm remains same, we will see that as well when we take some practical problem. We will see that as well. So if company pays dividend or does not pay dividend, wealth of the shareholder will remain same, and one step ahead, value of the firm will also remain same. And how it will remain same, we will shortly see when we take some practical example or practical problem. Okay? But as of now, do you have any queries in the formula? You have to just remember the formula. As per price is dependent on the expected dividend of year one and on the expected price in the coming year. बस आगे का मत सोचो. Future is very, very uncertain. You don't know what will happen in next moment with you. So forecasting future beyond a year is practically illogical. This is what said. Correct? So now let's take a practical problem and let's understand how theory works. Slide number 5. I explained that as per approach, whatever the dividend decision of the company may be, whether company pays dividend, whether it does not pay dividend, wealth of the shareholder will not change. It will remain same. Why? Because it is just a mere transfer of fund balance, of bank balance from company's bank account to individual's bank account. That's the reason that said that wealth of the shareholder will not change. Now, just like all the finance scholars gave their respective formulas to calculate share price, was feeling little complex. He felt little inferior, that why should I not give my formula as well? So even he gave his formula. The formula given by is the share price today is dependent on the future cash flows of only 1 year, not beyond 1 year. Okay? and future cash flows or expected cash flows would be in the form of dividend and would be in the form of market price at the end of year one. So you simply discount that. This is what MM said. Now let's take an illustration to understand it better. Let's say VIP Limited has a capital of rupees 10 lakhs. ठीक है? 10 lakhs of equity share capital and face value is rupees 100. Okay. The current market price of the share or the price at which the shares are trading in the market, let's say it is 100 only. It is trading at face value only. Now, company proposes to declare dividend in the coming year. Proposes to declare dividend of rupees 10 per share at the end of coming year. ठीक है? The capitalization rate or KE is, let's say, 12%. Now you have to calculate price of the share at end of year one. Okay? This is the first calculation that you need to do. Price of the share at the end of year one, and that too if dividend is declared. There are two conditions. Calculate price of the share at the end of year one if dividend is declared and if dividend is not declared. In both the scenarios, you need to calculate. Understood? This is the first question. Second part. Assuming that now company pays the dividend. Assuming that company pays the dividend and has net profit of rupees 5 lakh. This is expected net profit. Expected net profit at the end of year one. Company plans for an investment of rupees 10 lakh again in the next year. So calculate how many new shares must be issued. This is more or less a very exhaustive illustration that will cover the concept of MM. Okay? So first is the data is given. My company has an equity share capital of 10 lakh. Face value is 100. So tell me, what is the number of shares in the company? What would be my number of equity shares? बोलो कितना? 10,000? Yes, 10K. Current market price. The shares of the company are trading at 100 only. Now the company proposes to declare a dividend of 10 per share at the end of coming year. KE is 12%. Calculate price at the end of year one using MM approach. Since we are discussing MM, use MM theory of discount of dividend. Calculate price if dividends are declared. That means if rupees 10 is declared. Also calculate the price if dividend is not declared. Means this 10 is not declared. It was proposed, but shareholders disagreed. So dividend cannot be declared in that case. So we have to calculate price. Now let's calculate that. So case 1, when dividend is declared. Case 1, dividend is declared. Can I say price of the share today is nothing but D1 plus P1 upon 1 plus KE as per MM? Yes or no? So I have the market price today. This is P0. This is the price of share today. Are you getting this? And we have to calculate price at the end of year 1. Means we have to calculate P1. Hope everyone is following. So 100 is equal to, when dividend is declared, can I say my dividend amount would be 10 per share? I don't know P1. 1.12 raised to 1. My KE is 12%. It is given in the question. KE is 12%. So can you tell me what would be the price at the end of year 1 when dividends are declared? Bolo, kitna aega? 102. Everyone 102 or ki 112? 102. Yes, dividend is paid 102. So this is my price of the share today. Sorry, at the end of year 1 when dividends are declared. Any confusion till here? Any confusion, students? आगे बढ़े in scenario 2. Okay. Case 2. When dividends not declared. Now, company or the board of directors proposed the dividend, but it was not approved in the shareholders meeting. So dividend could not be declared in that case. So can I say my price? Again, the formula remains same. Can I say 100 is equal to, now dividend would be 0 because dividends are not declared, plus P1 upon 1.12 raised to 1. So can I say P1 is equal to 112. P1 is equal to 112 when dividend not declared. Follow any confusion in this second part? In case 2, any confusion? Yes. So sir, आप तो बोल रहे थे sir, you were saying that wealth of the shareholder remains same under both the scenarios. But यहाँ पे तो see sir, it is changing. When dividends were declared, price, expected price in the coming year is 102. And when dividends are not declared, expected price is 112, sir. There is a difference of 10. So how can you say that wealth remains same? So can I say when dividends are declared, the shareholder will get 102 if he sells the share at the end of year 2 plus 10 of dividend that he got in cash. So can I say ultimately his wealth or her wealth is 112 per share? Are you getting this? By selling the share, he or she will get 102. But during the year, company has paid dividend also, na? So that is also a part of wealth. Is everyone following this? Preeti, now it is clear why it is not changed. See, when the dividend is declared, now just visualize that you yourself are a shareholder. Okay? So you bought a share today. You bought a share today at 100. Okay. Now when company declares the dividend, the price becomes 102 after year 1. So let's say after year 1 you sell the shares. So can I say you will get 102 of cash from selling the shares? Yes or no? But during the year, company has given you 10 as dividend also. So can I say 102 plus 10 of dividend? Ultimately, you are getting 112 only. Sorry, 100 take FP or CMP. It is CMP, current market price. Current market price. Here, since it is same, we have CM. So here FP and CMP is same. That's why it is confusing. But you have to take current market price. P0 is nothing but price of the share today. Face value can be anything. We are concerned with the price of the share today. So can I say ultimately investor has got 112 rupees only. And when dividends are not declared, then price of the share at the end of year 1 is anyways 112. Is everyone following this? So wealth of the shareholder does not change. Hope this is clear. Again, this is what MM tries to explain, or MM concludes in his theory, that whatever, whether company pays dividend or not, कुछ फर्क नहीं पड़ता. I am indifferent or shareholders is indifferent. The wealth will remain same. ठीक है? Understood? So first part of the question is done. Calculation of end of year, that is done. Second part of the question is important. What is second part asking? Now assume that company pays the dividend. So in second part, first thing is that you have to assume that company paid the dividend. ठीक है? ठीक है? So scenario 1. Now we have to just focus on this scenario 1. As if the company pays dividend. The company has expected net profit of 5 lakh in the coming years, and company plans for an investment of 10 lakh. How many new shares must be issued? This is asked. Correct? Means ki company is planning for an investment after year 1 of 10 lakhs. Company has net profit of 5 lakh that is earned in the coming years. Correct? So can I say balance 5 lakh is only needed? Bolo, yes or no? Balance 5 lakh is only needed. I need 10 lakh of investment. I have profit of 5 lakh. So only 5 lakh would be needed. And to raise that 5 lakh, we will issue equity shares. Bolo, yes or no? No, friends, it is wrong. See. Net profit is of 5 lakh, correct? The expected net profit after year 1 is 5 lakh. But from this, can I say company will first pay the dividend? Because we have to assume dividend is paid. Company pays the dividend. This is what is being mentioned in the second question. So first, company will pay off the dividend from this net profit. Yes or no? Yes or no? And how much would be the dividend amount? Can I say 10,000 is the number of equity shares and company pays dividend of 10 per share? Can you see the question? 10,000 is the number of equity shares. 10 is the dividend per share. So from this 5 lakh, first 1 lakh would be paid off as a dividend. So amount available for investment. Amount available for investment would only be 4 lakhs, not 5 lakhs. Is this point clear to all? Hey, that is already issued shares. How can you issue the already issued shares? I didn't get your point. These shares, 10,000 shares are already been issued in the past year at the beginning. And this we are talking at the end of year 1. This all story, entire story is happening after the year 1 kind. So amount available for investment is 4 lakhs. And investment required is how much? Investment required or investment to be done is, can I say, for 10 lakhs? Yes or no? So in other words, balance of 6 lakhs I need to raise through equity. Did everyone follow this? Raise through equity. Any doubts here? What is by default assumption? What is by default assumption? See, this is the expected profit in the coming year and expected investment in the coming year. This is what question mentions. Are you getting this? Future की बात चल रही है. No. Question will mention na, here I have specifically written that assuming company pays the dividend. So question will, if there is no dividend to be paid, then question will mention that as well, assuming company does not pay the dividend. You have to read that question. Okay. So balance 6 lakh I need to raise through equity. Correct. Now I know the amount to be raised. Amount to be raised is 6 lakh. But I have to raise this 6 lakh at some price, na? At some price. And can I say that price would be year one ka price, which is 102. Hope you are following this. Because when dividends are declared, the expected price in next year would be 102. So I will issue the shares not at 100, not at face value. I will issue at the relevant market price at that point in time. Hope everyone understood this. So I will issue the shares at 102. So therefore, number of new shares to be issued would be, new shares issued would be 6 lakh divided by 102. Kitna aaya? No, not 100, Sukhveer. This is the mistake. 100 is the year zero, the price today, and everything is happening at the end of year one. Future की बात हो रही है. So future में obviously we will issue at future price, which is 102. 5882, correct. 5882. Follow any doubts here? So this was asked in second part, that how many new shares are to be issued. Understood? Now, can you tell me the total equity shares that would be outstanding at the end of year one? Can I say existing 10,000 plus new shares 5882? देखो ध्यान से. So number of new shares to be issued was 6 lakh divided by 102, which comes to 5882 shares. So can I say my total equity shares at the end of year one outstanding would be 10,000 the existing shares plus newly issued shares 5882, correct? So my total number of shares outstanding at the end of year one would be 15,882. And if I want to calculate the market value of the firm or the market value of the company at year one end, can I say market value is nothing but total number of shares outstanding multiplied by the market price. 15,882 multiplied by 102. So how much is the amount? How much is the market cap of the company? This is how you calculate market cap of the company. I don't know if you read newspaper or not, but many of times in newspaper you would have seen some words like market cap of Adani, market cap of Reliance Industries. This is what they mean by market cap. Market cap means total number of equity shares outstanding multiplied by the market price as on that date. So around 16 lakh 19,000 or around 16 lakh 20,000 approximately. Around 16 lakh 20,000. Riddhi, you are wrong. Wow, 6 lakh. 6 lakh, you have just considered the new shares issued. but already existing 10,000 shares are there na in the company. So you have to consider that as well. Yeah, no worries. I was just explaining on your error. So this is the market value of the firm when dividend is not declared. Okay? Now let's repeat the entire story when the scenario changes. Now let's repeat this entire story. Let's repeat this entire story. Yeah? Let's repeat the entire story when now assuming that company does not declare dividend. Okay? The entire story changes. Part 3. This is not asked in the question, but let's try to understand that. Let's try to understand that. Calculate new shares to be issued assuming that now company does not pay dividend. Assuming company does not pay dividend. Okay? Now let's change the entire story. First of all, when company does not pay dividend, can I say my P1 was 112? Hope you all remember this. When company did not declare dividend, my expected price at the end of year 1 was 112. No question in this, no debate in this, correct? Okay? So P price 112. Now my investment amount. Can I say net profit of 5 lakh will entirely be invested? Yes or no? Now I don't have to pay any dividends from this net profit. So I can entirely use this net profit in my investment? Yes or no? My investment required was 10 lakh. Since no dividend is to be paid, entire amount of net profit, I can invest it in the investment required. So balance amount is to be raised from equity. Yes or no? Balance of 5 lakh will be raised from equity. Correct? At the end of year 1. See, this entire story is happening 1 साल के बाद. So can I say I will issue at some price? I will not issue at face value. I will issue at the relevant market price. And the relevant market price in that case is 112. Are you getting this? So new shares to be issued. New shares to be issued when dividend is not declared comes to 5 lakh divided by 112. कितना आ रहा है? 4464. 4464. Yes or no? So I have to issue 4464 new shares if dividend is not declared. But if dividends were declared, I had to issue 5882 shares. Correct? This was the difference. Now, can you tell me the total number of equity shares outstanding? Total, huh? Not just the new one. Equity outstanding at the year end of year 1. Can I say 10,000 plus 4464, which comes to 14,464? Yes or no? And if I want to calculate the market cap of the company or market value of the company, it is nothing but just simply take the number of shares outstanding multiply by the market price. बोलो कितना आया? Again somewhere between 620. Yes or no? 16,19968. 1620. So can you see the market value of the firm, whether dividend is not declared or whether dividend is declared, it remains the same. देखो यहाँ पे भी 1620 था, and when dividends were not declared, the market value, market cap of the company remains the same. Not just the wealth holder, or not just the wealth of shareholder. the market value approximately of the company remains the same. This is the approx market cap of the company. This is what tried to conclude or tried to explain, that whatever the dividend decision of the company may be, company pays dividend, company does not pay dividend, company pays 10%, 20%, 50%, kuch bhi hone do, anything, the wealth of the shareholder will not change. Not just the wealth of the shareholder, approx market cap of the company will also remain same under both the case. So dividend decision or dividend policy is insignificant to the market cap or market price. Are you getting this? Any queries in approach? Is always on the negative side. He has always played the negative role in FM. Under capital structure theory as well, he said that any changes in capital structure, whatever changes you made in capital structure will not have any effect on your overall cost of capital and in turn on overall market value. Understood? So has always played a negative role in financial management का movie. उसके हिसाब से कुछ फर्क नहीं पड़ता. ठीक है? So in short, you have to remember the formula of all the finance scholar, be it Walter, be it Gordon, be it Graham and Dodd, be it this be it Lintner. Did you understand how to calculate new number of shares to be issued? So you have to think very logically and practically. How much is the profit available and how much is the investment required? Balance, we would raise through equity. This is a simple layman's logic. Can we move forward in our lives? Now let's take a practical problem from module on कहाँ गया वो क्वेश्चन नंबर 5. अरे question 7. Question number 7. Page number, let me give you the page number as well. Page number 8.44. Can you read this question 7? Akash Limited wala. Akash Limited has 10 lakh shares outstanding at the start of the accounting year. Means can I say this is at beginning at year 0.0. The existing market price is 150. Again, this is price today. Existing market price, current market price. So P0, this 150 is P0. Expected dividend is 8 per share. Can I say this is D1? D1 is nothing but expected dividend in the coming year. The rate of capitalization appropriate to the risk class to which company belongs is 10%. This is nothing but KE. Capitalization rate is KO. Ideally, the capitalization rate is KO. But here, dividend decision in my previous session, I have given a general assumption that unless otherwise specified, entire capital would be raised through equity only. The company is an equity financed company only. This is what I have explained to you, unless otherwise specified. So can I say KO here would be KE itself because only equity shares are there in the capital structure. Ideally, rate of capitalization means cost of capital. But here, since entire funding, entire financing is from equity, KO will be equal to KE. So this is KE. Calculate market price per share when dividends are given and when dividends are not declared based on approach. Okay? So again, let's calculate first part. Number 7. Calculation of market price at the end of year 1, P1, when dividends are, first case is I guess when dividends are declared. Okay, this is 1A, when dividends are declared. Can you all tell me the formula? What is the formula of under dividend decision chapter? D1 plus P1. Yes, correct. P0 is equal to D1 plus P1 upon 1 plus KE. P0 is 150. And if dividends are declared, how much is the amount of dividend? How much is the amount of dividend? It is 8 per share. I don't know the price because I have to calculate that. And cost of equity is 1.1. Correct? So how much is my P1? Yes, 157. 157. When dividends are declared. Now let's move to second scenario. Now let's move to second scenario. What does second scenario is asking? To, sorry, 1B. It is not 2B. It is 1B. Calculation of market price P1 when dividends are not declared. So when I say again P0 is 150, now D1 would be 0. P1 upon 1.10 raised to 1. Therefore, my P1 comes to 165. 165. Okay? So part 1 of the question is done. Part 1, they have just asked us to calculate the market price. That is done. Now second part. Calculate number of shares to be issued by the company at the end of the accounting year. Means they have asked to calculate new shares to be issued at the end of year 1. That the net income of the year is 3 crores. Investment budget is 6 crores. Okay? So you need an investment amount of 6 crores. You have net profit of 3 crores. So you have to calculate the new shares to be issued if company declares the dividend and if company does not declare the dividend. So let's take part A of second question. Part A of Roman number 2. Calculation of new shares, new issue of shares when dividend is declared. Let's take scenario of dividend is declared. Can I say first we will write the net profit available with the company, which is 3 CR. Yes or no? Which is 3 CR. But when dividends are declared, I will first pay out the dividends from this net profit. And balance amount I will invest. So how much is the dividend paid? Can I say number of equity shares are 10 lakh and dividend is 8 per share. So 80 lakh rupees of dividend would be paid. Yes or no? So from this net profit, let's first pay out our dividends. Balance amount will be available for investment. Balance available for investment would be 2 crores 20 lakhs. Yes or no? Any doubts still here? Our investment amount required is how much? 6 CR. Investment amount required is 6 CR, but we just have 2.2 CR. So can I say balance is need to be raised through equity? Amount to be raised through equity. Through equity would be how much? 6 CR is the investment required. Balance available with the company is 2.2 CR. कितना होगा? 3.8 CR. Correct? So I have to issue or I have to raise equity share capital of 3.8 CR. Again, I will issue this at some price. And what would be that price? That would be the current market price. Sorry, not current market price, but price at the end of year one, because everything is happening in the next accounting year. Yes or no? So when dividends are declared, my price will become 157. So new shares to be issued in that case would be 3.8 CR divided by 157. कितना आया? 242,038. 242,038. Can you tell me now the total number of shares outstanding at the end of year one? Number of equity shares outstanding at the end of year one? It is nothing but 10 lakh plus 2.42038 lakhs. So 1242,038. Correct? Any queries in part A of second point? Any doubts still here, students? We are going very logically, as if you yourself are investing in a business or as if you yourself are a businessman. 3.8 CR how? So net profit available with the company was 3 CR, correct? From this 3 CR, company will first pay the dividend because our scenario 1 is when dividends are declared. Correct? So from 3 CR, 80 lakhs would be my dividend that would be paid off. So balance profit available for investment would be 2.2 CR. Investment required is 6 crores. Amount available for investment is 2.2 CR. So balance obviously I have to raise through equity na, unless otherwise specified. Entire financing would be through equity. समझा? इसका who had this query how 3.8 CR came? Okay. So my total number of equity shares outstanding is 1242,038. Correct? Now let's move to scenario B. Calculation of new shares to be issued. Calculation of new shares to be issued when dividend is not declared. When dividend is not declared. ठीक है? So when dividend is not declared, can I say entire net profit of 3 CR would be available for investment? I can entirely invest this 3 CR in my investment of 6 crores. Because now we don't have to pay any dividend. So balance to be raised through equity would be how much? Through equity would be 3 CR. And obviously, I will issue this or raise this equity share capital at a market price when dividend is not declared. How much was that? 165? Yes or no? When dividend was not declared, my market price would become 165, not 157. Huh? So my issue price would be 165. Therefore, new shares to be issued would be 3 crores divided by 165. कितना आया? 181,818. Okay, everyone is getting this same answer. 181,818. So my total number of shares outstanding, total number of equity shares outstanding at the end of year one, at the end of accounting year one, is nothing but 10 lakh plus 1.81818, which is nothing but 11.818. Let's write in whole numbers. 11,81,818 shares. Everyone followed till here? Correct. So part 2, second question of question number 7, Roman number 2 is also done. Now what have they have asked in part 3? Prove that the market value of the shares at the end of accounting year will remain unchanged, irrespective whether dividends are declared or not. So you have to prove as per that market cap of the company remains same. Either dividend is declared or not, you have to prove that it remains same. So let's prove that as well. Part 3. Third part is proving when dividend is declared, when dividend not declared. We have to calculate the market cap, and market cap is nothing but total number of shares outstanding multiply by the market price at the end of year one. Bolo, total number of shares outstanding when dividend is declared. It is 1242,038. यहाँ पे हमने कैलकुलेट किया था 1242,038 when dividends were declared. So 1242,038. And what was the price? The expected market price at the end of year one when dividends were declared, it was 157. So multiply karo. Market cap. How much? 949. 9.5 CR approx. 19, not 9.5, but 19.5 CR. Everyone? Yes, approx 19.5 CR. Now my total number of shares outstanding when dividends are not declared was 1181,818. 1181,818. Yes or no? Multiply by what was my expected price at the end of year one? In that case, it was 165. So again, how much? It should come 19.5 CR only. So it should come 19.5 CR only approximately. Understood everyone? So market cap, whether dividend is declared or not, it remains same. So can you see the solution? 19.5. This is in lakhs. Hence, it is proved that the total market value of the shares remains unchanged, whether dividends are declared or not. Any questions, friends? Any doubts in approach? Now see, this is one way of proving that market cap remains same. Okay? This is the market cap, but before investment is made. This market cap is before investment is made. Has also given another way, has also given another way of calculating market cap. See, this is also an accepted way. This is also correct because you can see in the module the solution matches with our solution. So this is one way that is accepted by institute. But there is also another way of calculating market cap. What is that another way? It is based on the concept of discounting. Based on the concept of discounting. What did said, or say in another way? Market cap is nothing but 19.5 CR is correct. See, this is the approximate value before investment at the end of year one. From this, can I say there are certain earnings that you are gonna earn in the next year? Yes or no? That will add your value. That will add your value. Any earnings will increase your value. And any investment will decrease your value because you are paying out for investment. So what did say? What did say? Another way to calculate is when dividends are declared, 19.5 CR is your approximate market capital, but earnings of 3 CR will add some value to the company. So you add that and you deduct the investment amount. You subtract the investment amount because it will, at that point in time, it will reduce the value because funds are going from the company. So minus 6 CR, and everything is happening at the end of year one. Everything is happening at the end of year one. You discount this to calculate the present value. Are you getting this? This is what said, that another way to calculate market value of the firm is discounting the future value in present value terms. So can I say it is nothing but 19.5 CR plus 3 CR minus 6 CR divided by 1.1 raised to 1. 15. Yes. 15 ki 16.5. 15. Okay. 15 CR. Okay. When dividends were declared, this 19.5 was calculated. How did 19.5 come? It was nothing but total number of shares outstanding multiplied by the price. So it was nothing but, can I say it was nothing but 1242,038 multiplied by 157. 1242,038 multiplied by 157. Correct? This was how 19.5 was derived when dividends were declared. Yes or no? Similarly, when dividends are not declared, see, it will remain the same only because amount of net profit, amount of net profit, amount of investment and KE is constant. So it will come 15 CR only. How? So again, in that case, when dividends are not declared, my total market cap was 19.5 CR plus 3 CR of profit less 6 CR of investment divided by 1.1. divide by 1.1 and this 9. Arey yaar. Gosh. And this 19.5, the derivation of this 19.5 was 1181,818 multiplied by 165. So again, it will be 15 CR. So it is nothing but discounting of the future market cap. Another approach is nothing but discounting of, yes, this is the another way to prove. This is the another way to prove. It is nothing but discounting of the future market cap and also giving some relevance to your investment and earnings. Okay? So earnings primarily, as a layman, you think earnings will increase your market value because there is an inflow and outflow. At that point in time, will decrease your value. So we have added earnings, we have subtracted investment, and we divided by 1.1 raised to 1. Why? Because we are discounting the future expected value to present value terms. So both is correct. Both is correct because both the ways are considered by institute in module. Both the ways are considered. So one illustration they have solved by this way, by discounting way, and in question number 7 they have solved by this way. So both is valid because institute themselves have solved by both the ways. Okay, so they cannot give you wrong ideally. See, this is the approximate, this 19.5 CR. If you want to remember, this 19.5 CR is the approximate market cap after the end of year 1. And this 15 CR is the approximate market cap today. We have to just prove that value remains the same. Now वो 15 CR से आप prove करो कि 19.5 CR से prove करो. It doesn't matter. We have to prove that value remains the same. This 15 CR is value today because why? We have discounted the future market cap. And 19.5 CR is nothing but the future market cap only. We have to just prove that it remains same, whether at the end of year 1 or today. That doesn't matter. Hope everyone understood this. To market capital. Because like I told you, 19.5 is the market capital at the end of year 1. Approximate market cap at, okay. So both the methods are valid. Okay? So let's try to solve another question using the discounted method. Okay? Let's try to solve one more practical problem, but now using another method so that you get clarity on both the parts. Okay. Let's solve question number 1. Practical problem, question number 1. But now using the discounted method. Huh? Hey, what's happening? Question number 1. AM Limited belongs to a risk class for which capitalization rate is 10%. So KE is 10%. 25,000 shares are outstanding currently and the current market price is 100. So P0 is 100. It expects a net profit of 250,000 for 250,000 for the coming year, and the board is considering to pay a dividend of 5 per share. See the word, board is considering a dividend. So obviously it would be the expected dividend in the coming year and not the dividend that is already paid. So this 5 is nothing but D1. Huh? You need to understand the terminology of the question. M Limited requires 5 lakh for investment expenditure. Illustrate how MM approach affects the value of M Limited. So we have to show how MM approach affects the value of the company. We know that as per MM, value of M Limited, whether dividend is paid or not paid, should remain the same. This is what we have studied since the start of this session. It is just we need to prove in this question. They've asked prove how how value of the firm will remain same as per approach. This is what we have to prove in question 1. But now we will use the discounted method, the another method. Okay? So let's first calculate P1 when dividend is declared. I hope now you all can also calculate this, because we have done 2 exhaustive questions on this. As per price today is nothing but D1 plus P1 upon 1 plus KE. P0 is how much? Price of the share today. Current market price is 100 only. So when I say 100 is equal to dividend is declared and 5 is the dividend amount, P1 upon 1.1 raised to 1, 105. So my P1 when dividend is declared is 105. Now let's calculate new shares to be issued if dividends are declared. If dividends are declared. So can I say my net profit is 2,50,000, but entire amount of profit I would not be able to use. Why? Because I have to pay the dividend from this profit. Less dividend paid. Dividend paid would be 25,000 are the number of shares multiplied by 5. Dividend per share is 5, not 25. Okay. Dividend per share is just 5. So when I say 125, I will pay off the profit. So balance amount for investment would be 125. Balance amount available for investment would be 125. And I need investment of rupees 5 lakh. So again, can I say balance to be raised through equity? Equity, yes or no? Yes, 375. 375. So new shares to be issued. New equity shares issued would be 375 divided by 105. 35, 3571. 3571. So can I say total number of shares outstanding of equity shares outstanding would be 25,000 existing plus 3571 new, 28,571. Correct? Yes or no? Correct? And if we multiply it by the price, can I say I will get the approximate market cap at the end of year 1? Market cap at the end of year 1. बोलो कितना आया? 28,571 multiply by 105 are approx 30 lakhs. Yeah, 29,999. Yes, let's take round figure. 30 lakhs. So this is the market cap approximately at the end of year 1, which is 30 lakhs. But now the real market cap of the company would be 30 lakhs plus the amount of earnings. Earnings is 2.5 lakhs. Less the amount that is invested, which is 5 lakhs. And we will discount this because entire story or entire market value is at the end of year 1. So can I say my market cap today would be, or market value today would be 25 lakh. I hope now on Calci you are able to solve this. ये part जो है equation that you must know how to solve. ठीक है? So this is the market value of the firm when dividends are declared. So entire story of dividend declare is done. Now let's move to another part of the story when dividends are not declared. Scenario 2. When dividends not declared. So again, my P is 0 or my P1. Let's directly calculate P1. Would be 100 is my P0 since dividend is 0. Can I say P1 comes to 110 in this case? Okay, yes, correct. Now, next part. Entire net profit of 2,50,000 would be available for investment? Yes or no? Because I don't have to pay any dividend from this net profit. Okay, chalo. Dividend nil. Investment required is how much? Investment required is 5 lakh. So I just need to raise balance 250 through equity. Balance through equity shares. 5 लाख का इन्वेस्टमेंट चाहिए, 2.5 लाख तो है ही नेट प्रॉफिट से. So balance raised through equity. At what price? At price of 110. तो बोलो न्यू शेयर्स कितना आया? न्यू शेयर्स, न्यू इक्विटी शेयर्स इशूड हाउ मच? 250 डिवाइड बाय 110. 2273. 2273. So can I say my total number of shares outstanding? Number of equity shares outstanding would be 25,000 existing plus new issued at the end of year 1. So 27,273. And if I multiply this by P1, which is 110, can I say I will get approximate market value or gross market cap? कितना आ रहा है? 30 lakhs. Yes. Comes to 30 lakhs. But this is the gross market cap. The actual, the real market cap today or at year 0, this is year 1 end pay, would be 30 lakhs plus 2.5 lakh of my earnings. Sorry, this is not in bracket. 2.5 lakh of earnings less 5 lakh of investment. Since we are calculating the market value today, we will discount it using the discounting rate. 25 lakhs. Yes or no? Understood everyone? So let's see their solution. They have solved question number 1 using the discounted value. Can you see new shares 3572 when dividends are declared and 2272 when dividends are not declared? Can you see 25 lakh market cap? Correct? See, if you look at this formula, it is very confusing. It is very confusing. Sir, ये triangle and ये सब क्या है? At the end, it is this only what we have done. It is this only. जो किया है यही किया है. ठीक है. So I have explained you to calculate value of the firm under by using both the ways. Whether you discount the future market cap or you don't discount, the market value will remain the same. ठीक है. So institute have accepted, the module have accepted both the ways. I have shown you both the questions 1 and 7. So any method that you use in exam is correct. ठीक है. With this we end the approach. Any doubts in approach, friends? And exhaustively we solved 3 questions as well. One was illustration and 2 practical problems from module. And 2 practical problems we tried to solve using different ways. No doubt. Okay, clear, crystal clear. So if you look at the formula at first instance, it looks very confusing. ये सब क्या है? Triangle and plus and what is this? At the end, the logic is this only. They have done this only. This part only. So you should just focus on logic. This is what I would advise. ठीक है? Can we move to next dividend model, that is Lintner's model, which is more of a practical approach of dividend. See now Lintner, see now we are moving to next model given by Mr. Lintner. Lintner has not analyzed whether dividend decision will affect market price or not. He has not analyzed this part. It may affect, it may not affect. वो हमारा लुकआउट नहीं है. दिस इज व्हाट लिंटनर सेज. वो मुझे कोई लेना देना नहीं है वेदर डिविडेंड डिसीजन अफेक्ट्स मार्केट प्राइस और नॉट. My approach, my model, Lintner says that my model gives you the rough estimate of dividend to be declared in the current year. All the models that we have learned, whether it is Walter, whether it is Gordon, whether it is Graham and Dodd, whether it is all of them gave the formula to calculate the price, P0. Are you understanding? All of them, they gave the formula to calculate the price, theoretical price, intrinsic price today. But Lintner says, I am not analyzing what would be the effect of dividend decision on price. My formula is for current year's dividend. Current year mein, how much should be company ka dividend? Practically. This is what my theory says. This is what my model says. Okay? So you all fight. He says you all fight within yourself. Whether dividend decision affects or not, I am not concerned with that. I am least interested in that. My model specifically places reliance on what should be the amount of current year's dividend. Hope this is clear. Hope this is clear. Because understanding the base, understanding the background of each theory is very important. So this theory focuses on the approximate dividend or the expected dividend in the coming year. Whatever may be the effect on price, कुछ लेना देना नहीं है मुझे. So now what Lintner did, Lintner approach is practical approach. Why? Because he actually practically undertook a research and survey of various financial managers. I can directly give you the formula as well, but I guess it will not, you will not be able to grasp or digest that if I directly give you the formula. So instead, let's properly understand the whole background or the whole approach of Lintner. So what Lintner did, Lintner practically undertook survey and research of various financial managers. What was the survey about? The survey was all about dividend decision from financial managers' perspective. It was entirely based on dividend only. So he prepared few questionnaire, he gave them to the financial managers, and based on the response from those financial managers, he drew some conclusions. We are just concerned with the conclusions that Lindner has made. We have to just learn that. What were the conclusions of Lindner's? See, Lindner's model can be asked in theory as well, on theory part as well, like explain Lindner's model of dividend decision. So he undertook a survey of financial managers. He gave them certain questionnaires, and questionnaire was all about dividend decision. He Financial managers gave their response, and from their responses he drew certain conclusions, certain common conclusions of all the financial managers. What were that conclusion? That conclusion was, number one, financial managers, all the financial managers. Now I'm denoting the word financial managers in shorter, FM. All the financial managers have their target payout ratio every their target payout ratio every year that they want to achieve. See, you all also have a target that I want to score so and so much in my examination, correct? So everyone has their own targets. Everyone has their own vision. So here the financial managers have their set predetermined target payout ratio every year that they want to achieve. Let's say as a financial manager, my target payout ratio is 40% of the earnings. Your target payout ratio is 50% of the earnings. Someone else's target payout ratio is 20% of the earnings. So all of them had this target payout ratio that no, we have target payout ratio which we want to give to the shareholders. This we have in our mind. Everyone had. The payout ratio may differ from manager to manager, but everyone had this target payout ratio. It may be 20, 40, 60, 10, 15, anything, but everyone had this, that they want to achieve this. They want to achieve this target payout ratio. They want to give this target payout ratio to the shareholders. Understood point number one? So target payout ratio is nothing but it is on earnings. Yes or no? From earnings, we will pay out the dividend. Are you getting this? Point number one, समझा आपको? So every manager had a predetermined target payout ratio that they want to achieve every year. ठीक है? Can I move to the next conclusion? आगे बढ़ूं? Next conclusion was financial. Again, all the financial managers are concerned with percentage change in dividend than the absolute amount. फाइनेंशियल मैनेजर को ना एक पॉइंट पिंच हो रहा है. क्या पिंच हो रहा है? द परसेंटेज चेंज इन डिविडेंड रेदर देन द एब्सोल्यूट अमाउंट. लेट्स से देयर आर टू कंपनीज, द्वीप लिमिटेड एंड व्योम लिमिटेड. द्वीप लिमिटेड लास्ट डिविडेंड पेड वाज ₹10. ठीक है? एंड व्योम लिमिटेड पेड लास्ट डिविडेंड ऑफ 1000. So in absolute amount, Vyom Limited is paying higher amount of dividend. Now, if Dweep Limited plans to pay 15 rupees of dividend in the current year, and Vyom Limited expects to pay 1020 of dividend in the current year. So in absolute amount, Vyom Limited is paying higher amount of dividend. Yes or no? Yes, correct. In absolute amount, this is a small number, but financial managers are not concerned with this. They are concerned with this percentage change. Can I say Dweep Limited has implemented a growth of 50%? Yes or no? Has implemented a growth of 50%, and Vyom Limited has a dividend growth of just 2%. So they are concerned with this. Financial manager को ये percentage pinch होता है. Are you getting this? See, it is very logical ना. If last year it was 10 and now I now I give a growth of 50%. So can I say investor will get a feel that yeah, this company is giving a growth of 50%. So next year they would expect growth of 50% on this 15. And next year you may not get 50% growth. Are you getting this? So एक झूठी लॉलीपॉप मिल रही है शेयर होल्डर्स को. So they are concerned with this percentage. This pinches them. So they don't want to differ, or they don't want to have a major percentage change in their dividend. This is what all financial managers give their opinion. Did you follow this? They are not concerned with absolute amount. This company is giving 1,000 rupees of dividend. This is just giving 15. So in absolute amount, this Dweep Limited is giving very less dividend, but it has given a growth of 50%. Now this hits the financial manager. Okay, how can I grow dividend by 50%? Let's suppose in next year, I'm not able to achieve this growth. Then investors will not be happy with my company because they have expected, they have a preset expectation from the company that company is giving 50% every year. So next year also company will give us 50%, but it may not actually happen. Are you following? So they are concerned with percentage change in dividend. So they are concerned with a change in dividend with last year, but in percentage term. So from this target payout ratio, Lintner compared this target payout ratio, the current year's dividend, with last year dividend. This is point 2. Did everyone follow point number 1 and point number 2? Still it is incomplete. Huh? We have just covered 2 points. First point is all financial managers have their preset target payout ratio that they want to achieve. They want to achieve that. Okay? Second is they are more concerned with percentage changes in dividend. So if 10 say 15 हो रहा है, that will pinch them because it is a growth of 50% and company cannot give a growth of 50%. Yes, this will be absolute amount only, but at least see if this is 20, if the target payout ratio comes 20 and last year it was 10, can I say year only he can make out that there is 100% dividend growth. So he's concerned with this amount. Are you following? Still the formula is not complete. Huh? Only 2 points are covered. Next point. Next. Third. Dividend decisions once taken by the financial managers are irreversible. Dividend decisions once already taken by financial managers are irreversible. Means they don't want to change that dividend decision that they have only taken in previous year. So let's say, in other words, this entire phrase means they at least want to pay the last dividend amount. At least minimum itna to dena hi hai, because D0 was the dividend that company has paid last year. So this was their decision only, manager ka decision hi tha ye. This was decided by financial manager only. So at least they want to give that. Minimum last year jitna to milna hi chahiye. This is what every financial manager believe, that last dividend that we only have decided, we don't want to reverse that, we don't want to change that. Are you getting this? So minimum dividend the company should pay is at least D0. Itna to dena hi hai. Above D0 I would like to give something more. Are you following? Because this D0, again, this is the decision taken by financial managers only. So they don't want to reverse this. They don't want to change this. So when I say minimum dividend company should receive is D0. Plus over and above you should get. This is what Lintner said. Correct? And lastly, Lintner multiplied this bracket with a factor called adjustment factor. Adjustment factor or speed of adjustment. And this is an imaginary number. This factor is an imaginary number. Huh? This factor is an imaginary number. Even module has mentioned this, that speed of adjustment that Lintner has multiplied is not derived from any logic. It is an imaginary number. This module also specifies in one of its MCQs. I will show you that as well. But my research, I have went a little more in detail in this model. So my research says that this adjustment factor is nothing but the willingness. This adjustment factor is nothing but the willingness of financial manager to accept this part, to accept the change. The adjustment factor, my research, according to me, I feel that Lintner would have multiplied it with the willingness of the financial manager to accept this change. Let's say as per current target, let's say the current EPS is 10 and the target payout ratio set by the manager is 80%. So can I say my current dividend ideally should be 8? Now he will compare it with the last year dividend. Last year, let's say it was suppose 3 rupees. So can I say 5 का difference आ रहा है? There is a dividend growth of 5 rupees. So how much willing or how much willingness financial manager is showing to accept this 5 rupees ka change? This is adjustment factor. This is what I believe. How much willingness financial manager is showing to accept this 5 rupees ka change? Are you getting this? So if he is willing to accept this change by 20%, then it will be 5 into 20%. If he is more aggressive, then his willingness would be more high. Let's say 80%, then 5 into 80%. Are you getting this? Are you following this, friends? So adjustment factor, what I believe is nothing but a willingness of financial manager to accept this change of dividend. But some of the theories or some of the content says that it is just an imaginary number or it is just a balancing figure. But from examination point of view, you will be given this factor directly, not just this adjustment factor, all the variables will be given directly. Are you getting this? So this is the formula given by Lintner. It is nothing but D0 plus EPS into target payout ratio multiply, minus D0 and the whole multiply by adjustment factor. Okay? This is the formula that Lintner has given. You just need to remember the conclusion given by Lintner. The conclusions are all financial managers have their preset target payout ratio that they want to achieve or that they wish to achieve. Then they compare that dividend amount as per target payout ratio with the last year's dividend, which is D0. Correct? And how much willingness they are showing to accept this change is the adjustment factor. Third point, last but not the least, at least minimum of last year's dividend company should pay in the current year, because the decisions that are already taken in past years are irreversible. Company does not like to change those dividend. Financial managers does not like to change that decisions already taken. So this is how formula of Lintner is derived. Okay? Lintner model, as far as examination is concerned, you will get all the variables of this formula in the question. You just need to simply substitute the values and calculate the amount of D1. The core content of Lintner is that Lintner has given formula for D1 and not for price. All the other scholars, all the other finance researchers have given formula to calculate the price, but Linter has given formula to calculate the dividend. Okay. So let's see if any practical problem is there on Lintner or not. I couldn't find any practical exhaustive problem on Lintner, but I guess there is one MCQ. There is no exhaustive problem on Lintner in the module, but let me check if there is any MCQ on Lintner's model. See, can you first of all see question MCQ number 7? Which of the following is the limitation of Lintner's model? First, the model does not offer a calculation on market price of the share. As I told you, Lintner model offers calculation on the expected dividend. What is the expected dividend and not the price? So correct. So that is one of the limitation. Second, adjustment factor is an arbitrary, is an imaginary number and not based on any research or any logic. B. So answer is C. Both A and B are the limitations. That adjustment factor is just an imaginary number. So if you check the answer of MCQ number 7, it is C. Can you see? Answer is C to question 7. So even institute has accepted that adjustment factor is just an arbitrary imaginary number. It is not based on any logic or scientific methods, but I feel that it is based on the willingness of financial manager to accept that change. What is the conclusion? Conclusion of what? Question 7. Answer is C. Conclusion is C. Question 7 का conclusion is answer is C. So I guess there is no any other MCQ or any other exhaustive problem on Littner. But just for your understanding or for your better clarity, let me give you or let me make one illustration for you all so that it gets clear. Dividend payout ratio is 40%. Okay. Dividend payout ratio is 40%. EPS, earnings per share, is 20. Okay. Last year's dividend. Company paid dividend in last year of rupees 12. Of rupees 12. Okay. And adjustment factor or speed of adjustment, or I would say the willingness of financial manager to accept the change is 45%. Calculate D1 as per Lintner's model. So let's calculate expected dividend or the likely dividend as per Lintner's model. The first step is you just write down the formula. It is nothing but D0 plus EPS into target payout ratio of dividend less D0, the whole multiply by adjustment factor. Yes or no? This is the formula. Correct? So my D0 is 12 plus EPS is how much? EPS is 20 and my target payout ratio is 40%. Dividend payout ratio is 40%. So 20 into 40% minus D0, which is 12. And this whole thing will be multiplied by adjustment factor. which is 45%. So my D1 would be 12 plus 20 into 40%. 20 into 40%. And as it comes to 8. So it is coming in negative. Yes or no? It is coming in negative. So let's change the values of question. Ideally, it should not be negative. And if it isn't coming in negative, then negative is also fine, because at least you have to pay, or company has to issue at least 12 rupees of dividend. But as of now, let's currently change the target payout ratio to 80% for simple understanding purpose. Let's change this to 80%. So it will be 16 minus 12 multiplied by 45%. So financial manager is ready to accept a change of, is showing a willingness of 45% to accept a change of rupees 4. Are you getting this? This is what speed of adjustment is interpreted. He is showing a willingness of 45% to accept the change of rupees 4 in the dividend. कितना आया? So when I say it is nothing but 12 plus 4 into 45%, which comes to 1.8. So likely dividend in the current year should be 13.8. This is what Lintner said. Are you getting this? This is what Lintner said. Yes, correct. 13.8. So with this, we complete the second learning outcome of this today's session, that is Lintner's approach. So Lintner's approach, first of all, is giving his analysis on how much should be the dividend amount and not on the price. Okay? And his theory is based on his research of various financial managers. The conclusion of that research was, first, every manager has their target payout ratio. Second, financial managers are concerned with percentage change in dividend. And third, once the dividend decisions that are already taken in past are irreversible, that cannot be changed. Means at least last year हमने 12 decide किया था कि 12 was our dividend. So this cannot be changed. Minimum this should be given. Understood? So current year's dividend is 13.8. Now next year at least 13.8 should be given, because this is the decision already taken by us. Are you getting this? So next year it should be 13.8 plus something, because dividend decision once taken cannot be reversed. This is what Lindner said. Understood? So with this we complete Lindner's approach as well. Now residual approach. Residual approach, we don't have any practical problem. It is just a theoretical part. Residual approach, we don't have any specific practical problem, but just a very logical theoretical part. What does residual approach says? Residual approach, again, it is under a practical approach of dividend decision. It says that if company evaluates future projects which are lucrative, then don't pay any dividend. Retain the earnings, invest in those lucrative projects. After investing, if any balance is there with the company, then distribute the dividend. This is what ideally every company does. Whatever are the earnings of the current year, they first use it. They first use this profit in various lucrative projects that they are evaluating for their expansion purpose. And even after investing, if surplus is there, then company declares the dividend. Are you getting this? Residual means bacha kucha, surplus. Bacha hua profit you distribute. Otherwise, if you don't have enough profit, then don't distribute. ठीक है? So as per residual approach, earnings are to be invested in various lucrative opportunities available for expansion purpose. So first priority, you use that earnings for expansion purpose, for growth purpose. And even after investing, if you have surplus left, then distribute the dividend. Next, even after investing the earnings amount, any surplus left to be distributed as dividend. Okay? So this is a very practical approach, and I feel that most of the companies in reality are following this approach, that any earnings that they have with them, first they invest in their growth perspective or for their expansion purpose, and still if surplus is there, then they distribute the dividend. So it is win-win situation for both, for company as well and for shareholders as well. Okay? So clear? This is very simple. We don't have any practical problems in the module for this, but it is very simple to understand. Very logical. Even layman can understand this. Any businessman, even a local businessman, not the companies, not just corporates, even local businessman does this. Any profits that they earn from their business, they use them for their expansion and for their growth purpose, and then they take the surplus with them for personal purpose. Okay, simple. Any questions, friend? Bolo, any doubts in today's session till here? Clear? Okay. So now let's understand the concept of valuation. Last but not the least, concept of valuation. See, valuation is an ocean. The concept of valuation is an ocean. It is, I think, bigger than Pacific Ocean. And more detailed version of this concept you have at CA final level, not at intermediate level. You have at CA final level. But the relevant portion for our chapter, I will explain you today. Okay? Only the relevant portion. Again, valuation model is an ocean. It is a very big ocean. You have n number of models. You have numerous methods available to value a company, to value a firm, and all of them are acceptable. Even I would say, even you can prepare your own valuation model. You just need to justify this to the opposite person sitting with you. Are you getting this? So valuation is not a principle or a rule. It is not any principle or a rule. It is very logical, very flexible. I am saying that you can prepare your own model as well. It is just that you need to know how to justify that to the opposite person. Okay? So only the relevant part we will learn at CA intermediate level. Rest you will face it at CA final level. Okay? Now, what do you mean by valuation in simple terms? As a layman, now just think from layman perspective. What do you mean by valuation? What do you mean by value of something? Bolo. What do you mean by value of something? Bolo yaar. Valuation word you have heard n number of times before in your life. Determining the value means Okay, that is correct. Means in other words, it is nothing but estimating the worth of something. Estimating the worth of something. Yes or no? Correct? Yes, worth, correct. Hardik, correct. Assessing the worth, correct. Correct. Everyone. So it is nothing but estimating the worth of something. Now let's understand with some practical story. Huh? It happens with all of you as well. So let's say you all of you went for a shopping. Ideally, you are interested in window shopping. So you all went in a mall. You are fond of sports shoes. You all are fond of sports shoes. So there was a shop in the mall of sports shoes, and there were a certain pair of shoes displayed outside the shop. So as soon as see now how human see now see huh, how human psychology works. As soon as you see a certain pair of shoes, can I say immediately your brain will tell some price. Your brain will speak out some price of that pair of shoes. Yes or no? So let's say by seeing that pair of shoes, your brain said that this pair, according to me, should be worth of 6,500. Your brain did some processing within a fraction of seconds. Your brain did some calculation within a fraction of seconds, and it speaked out this price. Are you getting this? You would have seen the brand of that shoes, you would have seen the color, the design, everything, and based on that you have decided this price, or your brain decided this price. Yes or no? 6,500. Correct. Now you entered in the shop and you asked the shopkeeper that what is the price of that shoes on the display. He said that it is 3,500. Bolo, will you buy or not? My question. According to you, your brain speaked out a price of 6,500. When you went inside the shop, shopkeeper said that pair of shoes are costing 3,500. It is worth 3,500. Bolo, you will accept or not? Buy. Yes, buy. Why do we need to find the value of something to decide whether to buy or not? Are you getting this? Valuation ka objective is what? To decide whether to buy or not. So valuation is estimating the worth. In our example, it is nothing but estimating the worth of shoes according to you. And why are we estimating that worth? So that we can compare that with actual market price and decide whether to buy or not. Did you understand the concept of valuation? Valuation means deriving the approximate worth of something. And why do we do that valuation? To compare it with actual price and decide whether to buy or not. Are you getting this? So ultimate objective of valuation, the purpose of doing valuation is to make a decision whether to buy or not. Correct? समझा यहाँ तक? Any queries? Why are companies doing valuation? Or why researchers, investment researchers value a share of the company? Are you getting this? Why do they find the estimate worth of a share? So that they can decide, they can compare it with actual price and decide whether to buy or not. So in FM, we are not going to buy shoes, we will buy shares. So the concept still remains same. We will be valuing not shoes, but we will be valuing shares. And again, there are n number of models to value shares, to find the valuation of a share or to calculate value of shares. There are numerous valuation models available. One of those models that is relevant for our understanding is discounting model, dividend discount model. Which is that model? Dividend discount model. Other model, you will learn it at CA final level. But since we are learning dividend decision chapter, the relevant model for us is dividend discount model. So one way or one method of dividend of valuing a share is using dividend discount model. Now, what is dividend discount model? What is dividend discount model? How do you value shares using dividend discount model? A valuation of shares means calculating the price of share today. By valuing the share or estimating the worth of share means calculating P0. Correct? So as per dividend discount model, price of the share today is based on present value of all future cash flows. How is the share price estimated today? It is, so the dividend discount model says that it is based on the present value of all the future cash flows from that shares. Till now, any queries? This is little complex to understand. So we will go at a normal speed. I will ask you again and again that do you have any queries time and again. Okay? So dividend discount, see there are n number of models to value share. One such model is dividend discount model. Dividend discount models says that price or the worth of share today is based on the present value of all future cash flows. Present value of all future cash flows. So primarily there are two determinants. One is present value. So can I say we have to discount the future values? डिस्काउंटिंग जो इन्वेस्टमेंट डिसीजन कैपिटल बजटिंग में करते थे, डिस्काउंटिंग ऑफ ऑल फ्यूचर कैश फ्लोस, वही करना है इसमें भी. आर यू गेटिंग दिस? सो कैन आई से इट इज नथिंग बट फ्यूचर कैश फ्लोस फ्रॉम शेयर्स would be in the form of dividends. Yes or no? Why? Because we are using dividend discount model. If company does not pay dividends, then future cash flows would be earnings. Okay? So that would be earnings discount model. But right now we are just focusing on dividend discount model. So future cash flows from shares could be dividend only. Yes or no? शेयर्स में से फ्यूचर में क्या मिलेगा? सो डिविडेंड्स ही मिलेगा. सो यू हैव टू डिस्काउंट दोस डिविडेंड्स. तो कैन आई से P0 would be D1 upon 1 plus K raised to 1 plus dividend at the end of year 2 divided by 1 plus K raised to 2 plus D3 upon 1 plus K raised to 3 and till infinity. Are you getting this? Bolo. Dividend discount model says that price or the worth of share today is based on present value of future cash flows from that shares. What is the future cash flows from that shares? It would be in the form of dividends. So dividend at the end of year 1, you discount that. Dividend at the end of year 2, you discount that. Dividend at the end of year 3, you discount that, and you keep on discounting till infinity. This is what dividend discount model says. बोलो, any queries still here? Because ये नहीं समझा तो आगे नहीं बढ़ पाओगा. Any questions still here? Now see, now our next task is to guess what could be the dividends in future. What could be the likely dividends in future? So again, the likely future dividends could be three parts. Could be categorized into three parts. One is constant dividend in future, means ki dividend amount every year would remain same. This could be the one assumption. Yes or no? Second is there is growth in dividend but at a constant rate. So constant growth of dividend. Second is there would be growth every year in dividend. So let's say year 1 10 and the growth rate is 10%. So in year 2, dividend would be 10 plus 10%. In year 3, it would be 11 plus 10%. In year 4, it would be 12.1 plus 10%, and so on. But constant dividend rate says that dividend will remain constant throughout the life. Yes, yes. It is an assumption of dividend discount model that life of the firm is infinite, means perpetual succession. You have an assumption of going concern as well in accountancy, right? Means आज मैं company form कर रहा हूँ, I will not close it in 2 years or 3 years. It is assumed that company will continue its operation till on and on till infinity. This is what going concern assumption is. No one starts the company to end within a year or within 2 years. They want to continue till long term, till long run. Okay? So that same assumption applies here. Yes, perpetuity. Third assumption of dividend could be that dividend will grow at a variable rate initially, and after a certain period, 10 years, it will grow at it. Okay? So initially, let's say first year it grows at 10%, second year it grows at 20%, third year it grows at 30%, and then after third years, it will grow at a constant rate of 10%. Because after a certain point in time, we have to assume a constant rate because we cannot predict long future. We can predict future for maximum 3 years, 5 years. After that, we need to take a constant rate. We need to take a constant means fixed rate because we are not able to predict the future. So these three are the subparts of dividend discount model. Yes, after there will be maturity. Correct. So these three are the subparts of dividends. Like dividends, see, we are predicting that what could be the likely dividends. So the likely dividends could be either at a constant rate of dividend. It could be a growth, but at a constant rate of growth. It could be variable rate of growth in dividend initially and then at a constant rate. Okay? So the formula to calculate using constant dividend model is P0 is equal to D upon KE. Simple formula. The formula to calculate or to estimate the worth of share using constant dividend model is D upon K. This formula you have seen in cost of capital chapter as well. In cost of capital, it was nothing but K is equal to D upon P0. I hope you remember this. If the dividends are constant every year, cost of equity is nothing but D upon P0. Correct? There are 6 ways of calculating KE. One way was using constant dividend model. And the constant dividend model, the formula was K is equal to D upon 0. So यही formula से derive हुई है. Can you see this? Next, when constant growth rate of dividend is there, the price, the worth of share today is nothing but P0 is equal to D1 upon KE minus G. This was nothing but Gordon's model. Gordon's model was also known as constant growth of dividend model. Another formula in cost of capital was KE is equal to D1 upon P0 plus G. Correct? This was the Gordon's model to calculate KE. Yes or no? This is you have already learned in cost of capital chapter. Huh? So from this formula, we have done the derivation. Correct? Correct? And all the formulas, see, constant dividend model has its assumption. What is the assumption? That dividend remains constant every year? Under constant dividend model approach, there are certain assumptions that D remains constant, KE remains constant, लाइफ ऑफ द फर्म इज इनफाइनाइट, मीन्स परपेचुअल सक्सेशन. ठीक है. अंडर गॉर्डन्स मॉडल द अजम्पशन इज के शुड रिमेन कांस्टेंट, जी शुड रिमेन कांस्टेंट, के शुड ऑलवेज बी ग्रेटर देन जी, एंड परपेचुअल सक्सेशन. ठीक है. नाउ अंडर थर्ड अप्रोच, सी हाउ इज थर्ड अप्रोच. It is that under third approach, dividend will grow at a variable rate initially, will grow at a variable rate, and after a certain point in time, it will grow at a constant rate. This is third approach of dividend discount model. So can I say under third approach, since dividend is growing at a variable rate initially, I cannot apply this formula under third approach. Why? Because the assumption of first formula is that dividend should remain constant. Are you following? So I cannot apply this formula D upon KE. Yes or no? We are focusing on this model, variable rate plus constant rate model. So we cannot apply constant dividend model ka formula because there are certain assumptions of that formula that D should remain constant. But in our third model, D is variable initially. So we cannot apply that formula. Acha, we cannot apply Gordon's formula at the beginning. Why? Because Gordon formula also has preset assumptions. That what are the preset assumptions? That Ke should remain constant, G should remain constant, growth should remain constant. But again, can I say there is variability in growth? It is not constant at initial years. So I cannot apply Gordon's formula also in that case. Yes or no? See, this is little complex. Valuation part is little complex. So you need to understand, you need to grasp it very carefully. Constant dividend, this formula cannot be applied. Constant dividend ki formula cannot be applied. Why? Because dividend is not constant under third model. It is growing at a variable rate. They are variable. Dividend every year changes. Again, Gordon's model cannot be applied directly. Why? Because Gordon model has an assumption that growth rate should remain constant. Again, growth rate is not constant in initial years. So we cannot apply Gordon's formula as well. But yes. Gordon's module formula can be applied from this point, because from this point onwards, growth is constant. Are you getting this? Gordon's model can be applied from the year, from the future year, from where the growth rate is constant. Are you getting this? So बाकी के 3 साल का क्या करना है, बाकी के सालों को क्या करना है, you discount it normally using the normal logic. ठीक है. This is how you calculate P0. This is how you calculate P0 when variable plus constant rate is there. So till the years where variable rate of dividend is there, you keep on discounting. And from the point where it becomes constant, you apply the Gordon's model. So can I say I will get price at year 4 using Gordon's model? Yes or no? And I will discount that as well. Hope everyone understood this. This is little complex, complicated. In numerical terms, yes, I will explain that in numerical terms as well. We have one practical problem, we will solve that. But the concept is dividends can be of 3 types. One, it is constant dividend. Second, there is growth in dividend but at a constant rate. Third, there is variable growth in dividend initially, and after a point in time there is constant rate. Okay? So let's see if there is any practical problem on dividend discounting technique. So there is illustration 6. We have illustration 6. XYZ Limited, illustration number 6. XYZ is a company having share capital of 10 lakh of rupees 10 each. It distributed current dividend of 20% per year, per annum. The annual growth rate in dividend is expected at 2%. The expected rate of return on equity capital is 15%. So can I say K is 15%? What is question 5? Sorry, I didn't. What are you saying? I'm not able to get. Is test your knowledge 5 is the Q? Is test your knowledge 5 is the Q? Means question 5 practical. Practical question 5. Okay. First, let's understand the basic Gordon model. So basic Gordon model, annual growth rate is 2%. Calculate price of the share applying Gordon. So Gordon formula, you just need to simply apply Gordon's formula. Price is nothing but D1 upon K minus G. So the dividend paid last year is 2 rupees. D1 is nothing but D0 plus G. So last year dividend paid was 2. Growth is how much? Growth rate given in the question is 2%. So can I say my D1 comes to 2.04? KE is given in the question. KE is how much? Rate of return on equity capital, it is 15%. And G is 0.02. So can I say my P0 is nothing but 2.04 divided by 0.15 minus 0.02. बोलो कितना आ रहा है? How much it is coming? 15.7. Yes. So this is price of the share today using Gordon's model. Using Gordon's model. Okay. Now let's take practical problem number 5. Let's take practical problem number 5. ANR Limited is a large cap multinational company listed in BSE with a face value of 100 per share. Company is expected to grow at 15% for next 4 years and then 5% for indefinite period. So for 4 years, company will grow at 15%. The shareholder expects 20% return on their share investment. Means can I say this 20% is KE, our discounting rate. Company paid 120 as dividend per share for the current financial year. Okay? Company paid 120, means this is D0. Company had already paid this dividend. Find out the intrinsic value per share. See, intrinsic value is nothing but P0. You have various terminology for P0. P0 is also called intrinsic value. Sometimes question will mention theoretical value. Sometimes it will ask or it will mention expected value. All of them means the same. They are asking P0. They are asking to calculate the worth of the share, the estimated worth of the share. Okay? So theoretical price, you say intrinsic price, you say fair value, you say true value, you say everything means same. P0. Correct? So we know that P0 is nothing but discounting of future dividends. Yes or no? Plus D3 upon 1 plus K raised to 3 plus D4 upon 1 plus K raised to 4 and till infinity 1 plus K raised to infinite. Correct? Now, tell me what would be my dividend at the end of year one? What would be my dividend at the end of year one? Can I say initially 4 years company is growing at 15%? So can I say year one ka dividend would be 120 plus 15%? Yes or no? So 138 divide by KE is how much? 20%. Shareholders expect 20% return. So their expectation is cost to the company. बोला any doubts here? ये 138 कैसे आया? तो it is nothing but 120 plus 15%. Correct? Company initially grows at 15% for 4 years. So in next year, can I say it would be 138 plus 15%? So D2 would be 158.7. Yes or no? Divide by 1.2 raised to 2. Plus D3 again 158.7 plus 15%. 182.51 divided by 1.2 raised to 3 plus 15%, 209.88, correct, divided by 1.2 raised to 4 correct. Any doubts still here for 4 years? We have just added the growth rate. Each year. But company is now, after the end of 4 years, company is now growing at a constant rate of 5%. Yes or no? At a constant rate of 5%. Correct? So, from the point where company grows at a constant rate, can I say at this point, I can apply Gordon's formula? I can apply Gordon's formula because all the assumptions are falling place of Gordon after the end of year 4. बोलो यहाँ पे कोई query? I can apply because Gordon says that dividend growth should be constant. So can I say now my Gordon's formula will not be for P0, it will be for P4. Are you getting this? Because we are applying the Gordon's formula at the end of year 4. It will not be P0, it will be P4. Any doubts in this now? Why not P0 and why P4? Because Gordon's formula is applicable from the end of year 4 and not at the start, not today itself. So can I say his formula would be P4? Correct? Fast students, response fast. Okay. So can I say the formula? See, Gordon की formula क्या थी? P0 होता था तो it was D1 upon KE minus G. Correct? When there was P0, we used to take D1. So can I say when it is P4, we will take D5 upon KE minus G? Simple. When it was P0, we used to take D1. Since now we are calculating at year 4, we are estimating the worth at the end of year 4. So can I say it would be based on the dividend of year 5 upon KE minus G? So can I say D5 would be nothing but 209.88 plus 5%. Because now we have to apply a growth of 5%. Are you getting this? Because now dividend grows at 5% rate. So 209.88 plus 5%. Correct? My KE is 0.2. My G is now 0.05. बोलो कितना आया? 209.88 plus 5% divided by 0.15. 1469.16. Correct? 1469.16. Everyone, you got this price? Did you get this? So can I say, hey, is this price today or at the end of year 4? Is this the worth of share today or at the end of year 4? Is this 1469 worth of share today or at the end of year 4? At the end of year 4, correct? It is at the end of year 4, 1469. Yes or no? It is at the end of year 4, 1469. So we need to discount that as well. Are you getting this? This is not the worth of share today. This is the worth that we have calculated at the end of year 4. So we need to discount that as well to calculate worth today. Understood? So this is how third model, variable plus constant rate, works. Are you getting this? We need to calculate, find the worth today. But Gordon formula helped us in calculate the worth at the end of year 4. So we will discount that as well. Are you understanding? So can you, now I hope you know how to discount. So my P0, my net P0 would be how much? Can you calculate this in Calci and tell me? Now it is simple time value of money ka sum. You just need to discount future values. What 590? You are giving year wise? No, I want the final figure. I don't want year wise present value. अब मुझे directly बताओ. This 70851 is for year 1. Yes, for 1140.51. Okay. So my worth of the share today is 110.51. Hope everyone got this answer. Now this estimated price, this worth, we will compare with actual price. How much is the actual price? It says that the actual price, the share price trading in the company is 3122. So can I say it is overpriced? Yeah, are you following? It is overpriced. आपके हिसाब से worth should be 1140 only. The worth of shoes is 1140. And वो बिक रहा कितने में? 3122 में. It is been selling at 3122. Will you buy or not? Tell me, will you buy or not? We won't buy because it is overpriced. Okay? So the shares are overpriced. Understood how variable growth plus constant rate works? So from the point, from the year where the growth rate is constant, you apply Gordon's formula because all the assumptions of Gordon's are falling in place. So you estimate the worth at that year. In this case, it was year 4 because from year 4 onwards, growth was constant. Okay? So from year 4, we can apply Gordon's formula. So we applied Gordon's formula at the end of year 4. So we calculated, we found the price at the end of year 4. Okay? But we want to calculate the worth today. So we need to discount the price at the end of year 4. We need to discount this price. We need to discount the worth at the end of year 4 as well. How 1140? It is simple discounting. 138 divided by 1.2 raised to 1. Take 138 on Calci, divide by 1. Take 138 divided by 1.2 raised to 1. M plus. Now take 158.7 on Calci, divide by 1.2. Press equal to 2 times. Then 182.51 divided by 1.2. Press equal to 3 times. Last day means इस साल का लास्ट डे, करंट ईयर का लास्ट डे, नॉट एट द एंड ऑफ 5th ईयर. Last day of the 1st year. Or not, sorry, not last day of the 1st year. It is last day means previous day. एक दिन के पहले का प्राइस. just before the day when we are calculating this. Means today is 22nd November, then this price is of 21st November, previous day. Understood? So 1140.51 is simply discounting of future values on your calculator. So how to discount that you should know by now. Okay? So with this, let's end today's session. We covered approach, we covered Lintner's model, we covered residual approach, and we also understood the relevant portion of valuation concept. Only that aspect which is relevant at CA intermediate level. Okay? Any doubts? Bolo. Lintner's approach conclusion. 3 conclusions of every financial manager has preset target payout ratio. Second, financial managers are concerned with percentage change in dividend. Okay? The percentage change pinches them, not the absolute amount. Third, dividend decision once taken in earlier years are always irreversible. Means financial managers are reluctant to change the decisions that they have only taken in earlier years. ठीक है? ईगो हट होता है उसमें. Constant dividend and constant growth dividend. Constant dividend means dividend remains same every year. Dividend amount is constant. Means if dividend amount, let's say the last dividend paid was 10, so every year would be 10 only. D1 10, D2 10, D3 10, D4 10, D5 10. The amount of dividend is constant. Constant growth means the growth rate in dividend is constant. So let's say if growth is 5%, so every year dividend will grow by 5% only. So D1 में 10 plus 5%. 10 plus 5%. कितना आया? 10.5. 10.5. D2 में 10.5 plus 5%. So dividend amount will change, but at a constant growth rate. And under constant dividend approach, dividend amount doesn't change. Last calculation, कौन सा calculation? TYK9. What is TYK9? What is TYK9? Your question should be clear. Huh? It should be understandable. I am not able to understand what is TYK. So I guess our session was till 8:30. So we can continue that in revision lecture. Whenever revisionary lecture of dividend decision happens, we can solve that question number 9. Because already we are 10 minutes over time to our normal session. Practical question 5, last calculation. Which last calculation? Last calculation was just discounting. It was just discounting of all the cash flows. You discount 138. You take 138 on calci, then divide by 1.2, press equal to 1 times. You take 158.7 on calci, divide by 1.2, press equal to 2 times. You take 182.51 on calci, divide by 1.2, press equal to 3 times. You take 209.88 on calci, divide by 1.2, press equal to 4 times. You take 1469.16 on calci, divide by 1.2, press equal to 4 times. This is how you calculate. No, tomorrow, yes, tomorrow we have lecture on management of working capital. ठीक है, so let's end today's session. Thank you all. Do practice some other questions from module. Try it by yourself, and during revisionary lecture of dividend decision you can ask your queries. Okay, have a nice day. Sorry, have a nice evening. Yes, yes.